Hi, Mark Zuccarati here with Whitecap Mortgage. Thanks for joining me. I wanted to do this COVID class again, how COVID is changing the lending industry. When we did this live, the sound was a little muffled, so not a lot of people tuned in or got to hear it. So here we go. I think it's very important. There's some hot topics in here that I think is important for you guys to understand, or at least know there's going to be some red flags, and to get with your mortgage person to kind of help navigate this. So I'm going to go ahead and downsize and get right into this. All right, so here we go. Let's talk about some quick facts here. June 21st, we were up to 2 million reported cases of COVID. The number of unemployment rose from 3.8% in February to 13% in May. The number of mortgages in forbearance rose from a quarter percent in February to 8% in June. Right, and so this is some of the core reasons to why lenders have tightened up. Unemployment and forbearance, two hot topics. So how has this affected lending? Right? How has COVID, who's affected by the lending changes? It's really the high risk loans. So marginal loans with low down payment, low credit scores, high DTI. It's obvious, right? These are riskier clients. Lenders, if there's any risk to them, lenders have suspended mortgages for those marginal loans, or for the riskier clients. We have investors and self-employed, right? They're not super high risk due to credit score or low down payments. Typically, they're quite the opposite. However, because of COVID and because of the shutdown, self-employed borrowers, their income has changed, right? What they used to, some are doing a lot better, and some are doing a lot worse, right? So that's being heavily looked at, and investors. So there's more overlays to an investor, and importantly, investor, the first loan that they're not going to pay, the first debt that they're not going to pay, is possibly a rental property where the tenant may not be making the payment because the tenant is now unemployed. So those are riskier. And we've got our non-conforming, the jumbo loans. Almost immediately in March, when things started changing so rapidly, jumbos were one of the first mortgage products to go. They're riskier, right? So they're not insured by the government. So lenders did not want to be stuck with these high balanced mortgages, who a lot of these are self-employed, where income was being affected. And so there was no appetite for the secondary market here with this loan. Almost immediately, they were suspended. Now we're starting to see them come back slowly, very slowly, and with a lot higher criteria to qualify for that jumbo product. So you're not seeing the 5% down jumbo right now. You're seeing 20, 25%. I'm starting to see 10% come back, but it's with a higher rate. You're not getting that the rates in those threes with the lower down payments. Out of the box loans, these are your non-QM. Non-QM basically were suspended right off the bat as well. There was no appetite for loans that were out of the box, that were not being insured by Fannie Mae or the government. Reno loans, they were suspended. A lot of lenders were suspending these products. We do have Whitecap Mortgage. We are still doing a lot of renovation loans. They're still happening. However, the pool of lenders that are doing them have shrunk. Why? When the government was shutting down, official ability, you couldn't get a permit. It was harder to get a permit. It was harder to get inspections. Contractors weren't allowed to come out to the house. And so these types of loans, they have to be completed within 4 to 6 months. And so to try to get anything done 4 to 6 months on some type of renovation project, was almost impossible to get. So lenders just suspended them. But not all. All right. So let's talk about some lender overlays. This is specifically going to be talking about the credit score overlays. And most of you probably know what an overlay is, but I'm going to just touch on it. An overlay is basically Fannie Mae, FHA, USDA, they all have their guidelines. The guideline for a credit score for a conventional loan, 620. Fannie, Freddie says, I'll take any loan, we'll buy a loan, as long as they have a 620 or above. That's one of the criteria. However, due to COVID, the lenders have applied an overlay, meaning an additional guideline or additional restrictions to who they're going to lend to. Some have gone all the way to 680 credit score requirements during COVID. I've got some down to a 640. Very tough to get anything below a 640 right now. And why would a lender apply these overlays? It's because if somebody does not make their payment, even though Fannie Mae may have purchased this loan or agreed to, if there's a default or a slow pay, the lender is required to buy that back from the investor, Fannie Mae. No lender wants to be purchasing loans right now and having this on their books, or an issue with not selling it because somebody did not make their first payment. So they apply an overlay. Fannie Mae says 620. The lender says, we want 680 because we don't want to get ourselves into trouble buying loans. So we got VA, 600 to 680. FHA, 600 to 680. USDA, 640 to 680. Jumbo, we're up in the sevens. And so it's very important why there's a range is because there's some lenders that have heavier overlays than others. So it's very important that you have multiple lenders, because one lender may say, oh no, FHA, we're not, 680 is the lowest credit score. That is for that lender. Other lenders are still doing the more under 680. So it's important to be partners with either multiple partners, multiple lenders, or somebody like myself, we're a mortgage broker who we've got avenues and we know who is lending where, and we have the ability to place those loans for your clients. All right, so let's get into our self-employed person. All right, so it's very important to note here, self-employed borrowers have taken a big hit during this market. How we're evaluating their income is significant. There's significant changes. And I think a lot of us can probably relate because you're 1099, you're self-employed, you're considered an entrepreneur. And so we are forced, when we're calculating income right now, we're forced to look at the lower of one of these three bullet points. The 2-year average, the most recent year's average, or the year to date, whatever is lower. So for example, we get the 2-year self-employed tax returns and we take an average. Then we just look at the most recent year and take an average and see what that income is. And then we want to see what the year to date currently is looking like. And whatever is the lower income, that's the one we're going to use. So you could have, let's talk about you personally, you could have had a stellar year last year and sold 50 homes. And you're thinking about buying a new house. Business is a little down right now. We're not selling as many, but we know it's going to come back. We were basically shut down 3 months, possibly, where people were just cooped up at home. So your income is probably half of what it was last year. Normally, we could have averaged that. Right now, we would be looking at the year-to-date income, what you've made so far, and utilize that for your qualifying to buy a new house. This is pretty significant because your buyers who were out looking earlier in the year or possibly last summer who have circled back around, they may not qualify. Do not assume that somebody who was qualified last year can qualify this year. Or somebody who couldn't qualify last year it could be quite the opposite. Their business has taken off during COVID. They sell things online. More people have gone to buying things online. So I know a lot of entrepreneurs who business has taken off. So we got to reevaluate these clients. All right. So we're also looking at receipts over the last 10 days prior to closing. So we got to get their bank statements to make sure their business has not been affected currently, that they're still getting the receipts. So this is really annoying for self-employed borrowers. So we just have to get in front of that, and it's knowing these changes will help you kind of navigate as well, or at least understand. All right, so investor overlays. Nearly all lenders require now reserves for the self-employed borrower. This is also very important. If you deplete your assets, if you're a self-employed person and you've met the income requirements now and you qualify, but you're depleting your assets to buy this house and you have no reserves sitting in the bank, we're forced to now, some of the lenders have applied some overlays, chopping the income upwards of 25%. So if we calculate your income to be $100,000 for the year and you have no money in the bank, or you're depleting it to buy this house, 25% could possibly be chopped, and now we can only use $75,000 to qualify you. That could make you not qualify to buy that house. So again, this is pretty significant changes here that we want to stay in front of. So let's talk about the next thing: forbearance. Forbearance. If this is something that's very important, because it could bite everybody, a lot of us, if we're not aware of how forbearance affects your buyer in buying their next home, if they're currently in a forbearance, right? So when forbearance first came out with the CARES Act, there was a 12-month waiting period. If you went into, if your mortgage went into forbearance, you had to wait 12 months once you got out of forbearance. Well, since COVID, there was some assistance to help people who went into forbearance. So there were some leniencies, right? So here, let's go over that. Borrowers continue to make all payments on time and in full while in forbearance can buy another house. Just because you go into forbearance doesn't mean you're not making your payment. So some people took advantage of forbearance just in case. We don't know what tomorrow is going to bring. So you get approved to go into forbearance. However, you still make your monthly payments and you're still fine to buy a house. Right? So borrower is out of forbearance and on a repayment plan. As long as they've made 3 timely payments, they can buy again. However, you can't get out and just make 3 payments all at once and assume that's okay. You can't do that. You have to make 3 consecutive monthly payments, and then you can buy again. All right, now borrower is out of forbearance and resolves missed payments through being reinstated and bringing the account up to date all at once. However, what's important to note is that you cannot use the proceeds from the sale of the house to bring your mortgage back up to date. You have to get out of forbearance, make the payment. Let's just say you skipped a couple payments and now you owe $5,000 in that to bring your mortgage back up to date. So you get out of forbearance, you pay $5,000 with verified funds, and then sell your home, you're okay to buy. But in this scenario, you sell your home, you use the proceeds to bring your mortgage back up to date, you have to wait 12 months to buy a house again. This is very important. You need to be asking your clients, are you currently in forbearance? And if they say yes, you may not remember this, but you say, here, call my mortgage guy, and let's make sure we do the right steps to make sure when your home sells, you could buy another house. Or even if they didn't have to sell, maybe they have already sold and they're in a rental. What did they do? Did they use the proceeds to get out of forbearance? So these are questions that we normally didn't have to ask. It's very important to ask them now. All right. So employment verification, for a while now, we've been verifying employment up front And we've been verifying employment 10 days prior to closing. It was just a rule that we've had to comply with. We had to verify employment at least 10 days. That is no longer considered due diligence, right? So we have to now verify 10 days before closing, the day before closing. Sometimes 3 verifications are done in that 10-day window before closing. And sometimes it's done post-closing. After we close, they're still verifying employment before they can sell this into the secondary market. So somebody like Fannie Mae may require another verification to be done before they'll even purchase. So how can this affect us, right? One, it's the timing. What if we can't get a hold of the HR department right before closing? And so you may have experienced this. Why are we doing verification so late in the game? It's because of this, right? So we got to check multiple times now. And what happens if we find out they're furloughed right before closing? They're no longer eligible. They can't close. The borrower is receiving reduced pay. So if we find out that we qualified them, or they qualified before a couple months ago, and now they've restructured how they're getting paid, and they've agreed to take a lower pay for a period of time. Well, now it's considered we have to take the lower pay to be able to make that stable income. Unemployment just can't be used. If they're collecting unemployment, they could be collecting more money today in unemployment than they were when they were employed. Doesn't matter. We can't use that income, and so they have to be back to work. It has to be stable income. They have to be receiving that income to be able to qualify them. All right, so the next topic that we've started seeing some issues on appraisals. And why? Because, I think all of you guys will probably understand the supply and demand. There is a huge demand because of lack of supply. You can see the chart. We're currently, way down in existing homes. And so when that does, it drives the price up. And people are bidding sometimes more than the asking price. Sometimes what we're seeing who's being affected is the client who's raising the price to get settlement help, right? So if they're asking $200,000 and they need 3%, they go in saying, we'll take it for 206, and can we get 3% settlement help? If that appraisal doesn't hit, do we have a backup plan? What's going to happen, right? Do they have the asset or a family member to help them if the appraisal does not hit? Because we are starting to see there's a lag between what you guys are selling today and what was selling 3 months ago, right? The prices are up. And so the appraisers start having a difficult time to find comparables of during COVID, pre-COVID, is this a stable, is this a normal market? All these factors go into when they're looking at comparables, what has sold recently. There's lack of inventory. There's not as many comparables for an appraiser to use. So why this is important is just talking to the sellers, talking to your buyers. Hey, if we have a concern here, I know that we're asking a little bit more, but here are the ramifications of doing this. And it's the appraisal. And so let's get in touch with the lender. Let's let the mortgage guy help us through, navigate. Let's come up with a plan B, sometimes a plan C, if we have an appraisal concern. And if we deal with it up front, it's not as dramatic when it actually, and if it does happen. If it doesn't, great. We were just prepared and we didn't have to go and use plan B or C. But for me, when I'm talking to clients and they're making offers and they need the settlement help and maybe it's a tight market like this, we start having these conversations. Here's what plan B looks like. Here's what plan C looks like. If this occurs, here's our exit strategy, or here's our maneuvers around this. Here's how we can resolve the issue. All right. So we just have to have these conversations now. All right. So let's take a look at some of the lender overlays that we've seen in the marketplace. Not all lenders. This is an overlay. Not all lenders have the same overlay. So it's important that you're with a mortgage person who can navigate these overlays. All right, so let's jump in. 6 to 12 months reserves required for rental properties. All properties owned are needing reserves right now. No future or projected income. So this means if you are a teacher and you got a new job and you're expected to start in August, and I got an offer letter. We used to be okay with that. Right now, there's some overlays out there that you can't use offer letters. And so you have to be working and you have to be receiving that income. No manual underwrites, meaning if it did not score the automated underwriting approved eligible type scenario that normally we could at some point, this loan makes sense. It just didn't score by the computer. So let's get a human being to look at it. Let's massage this thing into a real deal. That right now, if it's not scoring in through the computer, lenders aren't accepting that massaging into a deal and having a human being overturn, I guess, the computer. Escrow holdbacks. So if there's some sort of repair that needs to be done and you didn't want to, just wasn't being able to be done before closing, the escrow holdback is kind of been suspended for a lot of lenders. You may want to look at a renovation loan if something comes up with a inspection or an appraisal. And we are certainly doing renovation loans. Some lenders have discontinued down payment assistance or grants. So some of your avenues for that may have dwindled. I know they're still out there. People are still doing them. There's lenders. We've got some down payment assistance available to us. So I know that we're doing them. But some have discontinued or suspended them temporarily. And the 80-10-10s, these equity loans, they're becoming a little bit more difficult to find. And to do the hybrids to stay out of the jumbo, these were very popular to take two mortgages to avoid the jumbo loan. That's it's difficult to find as well right now. All right, so let's talk about some positive things. We've got here the chart of the bonds, mortgage bonds. Back in February, we're around 3.75. You can see here in March, mid-March, we had a lot of turmoil going on. This is, the Fed came out and basically made the Fed rate down to zero, and there was liquidity issues going on. There was a severe issue back in mid-March. In April, we kind of dug our way out and stabilized, and we've been very stable. You can see it's a bit of flat line since then. 3.25 has been on the upper marks. I'm getting people as low, depending on the situation, into the 2s right now. Certainly with points, you can get into the mid 2s on a 30-year fix. So this is great. I mean, what people were buying homes for in February at 3.75, their mortgage payment is much lower now. So people who didn't buy or who maybe didn't qualify because the payments were a little bit more, you might want to recircle back and say, hey, rates are low and maybe we want to reevaluate because that the homes that you were interested in that price range that might have fell out of your price range may be in your price range right now, a whole percentage point below or a whole percent. So you might want to circle back around to some of your clients. All right, another positive change. We've seen some hybrid closings and this remote online notarization, or the RON is what they're calling it. So the RON is basically you're sitting, the attorney is in their office, your buyers are at their home, and they're doing like a Zoom closing. So they've allowed this temporarily due to COVID. And I've talked to some attorneys and they have done this. It's not all digital. So they're actually ink signing through Zoom. So the attorney is watching them ink sign. And this is, there's a lot of title companies who aren't accepting the digital version of a RON yet. And so it's slowly coming around. And I think, due to the pandemic, it was kind of forced to be used. and maybe it's not as bad as what people are making out to be. Maybe it's not going to work, but it's these things kind of open the door to a new way of doing business. A hybrid e-closing is certainly being done a lot more. Not all lenders have gone to the hybrid, but that's basically you're signing 90% of the closing docs at home or in the lobby, not sitting around a big table doing it. So you can kind of speed up the process. Now, you're still going to need to ink sign in front of someone, the attorney or a title company notary, the recorded documents. And you guys might have experienced this already. So, with change in the world brings change to our industry. So, all right. So how can we help our clients navigate through these changes? Here we go. We need to communicate with each other. Lenders, loan officers, the realtor, the buyer, your seller, everybody needs to be communicating, staying on the same page. There's product updates. It's important for us to be in front of you guys doing things like this so you're aware of the changes as things get come back to maybe some normalcy. Maybe some overlays will be lifted, and we'll be right here to let you guys know. All right, so don't assume your well-qualified buyer is still qualified. Don't assume it. Just get them back in front of a mortgage person and say, hey, I know that you were that $1 million buyer last year. Can we just, let's just reevaluate, get with Whitecap Mortgage and just double check, just make sure everything's okay. Because we know that there's been some changes to underwriting guidelines with self-employed buyers or investors. So as soon as we start assuming people are okay or that they're the well-qualified, that's when things normally sneak up on us. All right, have the conversation with your clients, both buyers and sellers, about forbearance. It's very important. This one will catch up and bite you as well if we're not asking that question. And it's a very simple question. Hey, are you currently in a forbearance? Yes? Okay. Here's what we're going to do. Let's get you in front of Mark Whitecap. He'll guide you through how we can get you moving in the right direction, because we just don't want to get tripped up at the end. You're able to buy again, Mr. Buyer or Seller, but we got to go through a procedure. And so if we don't, we could get caught up where you might have to wait 12 months before you can buy your next house. So in order not to fall into that trap, let's kind of nip it right now. All right, so that's that kind of conversation. Hey, work with us, COVID overlays. These overlays are maybe here for good. Maybe they're temporary. It took a lot of time to get out of the 2008 overlays, years. And so I don't think that we're there. I think that the overlays are going to be lifted a little bit quicker. We just don't know what the future is going to bring to us. So it's important to be with a mortgage person who has multiple avenues. And if you're very comfortable with your lender, that's awesome. Just know that they're not the end of all. And so maybe if they can't do something, you have a second source. And I would love to be that second source for all of you guys, if not the first. So, all right. So while the pandemic did not create the need for digitalization and automation, and clearer policies, better customer service, it did make mortgage executive prioritize and make these things very important. So it should make our industry stronger and more focused right now. And that's just from an article I read. I thought it was pretty cool. So again, thanks guys for allowing me to teach you. I hope you hung out. If you made it this long, here's my information. And we'll be doing this here often, keeping you guys updated. And I am going to be in the Bethany office. So again, thanks guys. And I look forward to meeting every one of you. All right.